Most business owners manage their cash flow the same way. They check the bank balance, and they hope. There is a better way, and it does not require a finance degree or a single spreadsheet. It requires one mental model that Treasury professionals use to turn cash from a source of anxiety into a source of strength. The model is 3 buckets. Every dollar your business holds belongs in one of them, and the entire art of cash flow management is knowing how full each one should be. The first is the operating bucket. This is the oxygen of the business, the money that covers the day-to-day flow of paying what you owe and collecting what you are owed. The crucial insight here is that timing matters more than amount. A business can be profitable on paper and still run out of oxygen if the money it is owed arrives after the money it owes is due. Managing the operating bucket is not about having more. It is about controlling the timing of what flows in against what flows out. When you understand the rhythm of your own receivables and payables, you stop being surprised by your own cash position. The second is the reserve bucket. This is the insurance of the business, the buffer that absorbs the shocks that every business eventually faces. The question is not whether to have a reserve, but how deep it should be. And that depth is not a guess. It is calculated from your own burn rate, how much the business consumes in a normal period, and your own risk profile. A business with steady, predictable revenue needs a shallower reserve than one with volatile or seasonal income. Setting the water level in this bucket deliberately, based on your actual numbers, is what lets you face uncertainty from a position of preparation rather than fear. The third is the growth bucket. This is the fuel. Once the operating bucket has the oxygen it needs and the reserve bucket is at its proper level, the money beyond that should not sit idle. Cash that sits motionless in a zero-interest account is not safe. It is quietly losing ground to opportunity cost. The growth bucket is where excess cash is deployed to work for the business while staying within reach. This is the bucket most business owners never get to, because they never deliberately fill the first two. And so their growth fuel sits unused in the same account as their oxygen, doing nothing. What ties the 3 buckets together is forecasting. A simple weekly or monthly view of what is expected to flow in and out lets you see a shortage in the operating bucket before it arrives, rather than discovering it the day a payment fails. Forecasting is not prediction for its own sake. It is the difference between steering the business and reacting to it. This is the shift the 3 buckets make possible. You stop asking the anxious question, "Do I have enough money right now?" And you start asking the strategic one, "Is each bucket at the level it should be?" That single change in the question you ask is what separates a business that survives its cash flow from one that commands it.